Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we're going to be solving Hebac company question. This is a September 2016 question, past paper question from your financial management exam. So pertains to investment appraisal. Just before we get started, so this is a section C question. So the very first thing that we do is read the requirements. And then, get started with the scenario. So I can see that there are two requirements over here. Requirement A wants me to calculate the net present value of the investment project in nominal terms and comment on its financial acceptability. This is for 12 marks. And the next part wants me to discuss how the CAPM model can assist the company in making a better investment decision with respect to its new product launch. This is a theoretical discursive requirement for 8 marks, hence totaling to 20 marks. Right. So let's read the question now. I know that the very first thing which I have to do over here is work out the nominal NPV. So I can say part A over here and type nominal NPV. Right. So I have the information. Hebac company is preparing to launch a new product in a new market, which is outside its current business operations. The company has undertaken market research and test marketing at a cost of $500,000, as a result of which it expects the new product to be successful. Hebac company plans to charge a lower selling price initially and then increase the selling price on the assumption that the new product will establish itself in the new market. Forecast sales, volumes, selling prices, and variable costs are given to you. So you have the sales volume for 4 years, selling price, as well as your variable costs. Now, selling price and variable cost are given here in current price terms before taking into account a forecast selling price inflation of 4% per year and your variable cost inflation of 5% per year. Now, the incremental fixed costs of $500,000 per year in current price terms will arise as a result of launching the new product, and the fixed cost inflation is also there. Then new initial investment cost of production equipment for the new product will be $2.5 million, payable at the start of the first year of operation. Production will cease at the end of 4 years because the new product is expected to have become obsolete due to new technology. Now, the production equipment would have a scrap value at the end of 4 years of this money in future value terms. Investment in working capital of $1.5 million will be required at the start of the first year of operation. Then you have your working capital inflation given to you, and the capital will be recovered in full after the end of 4 years. Now, Hebac company pays corporation tax at 20% per year, with the tax liability being settled in the same year. Then the company can claim TAD on a 25% reducing balance basis on the initial investment cost adjusted in the final year of operation for a balancing allowance or a charge. And then Hebac company currently has a nominal, you have the cost of capital given to you at 12%, at which you have to discount, and the real after tax WACC is also given to you, and then the company uses its current WACC as the discount rate for all investment projects. Now, without any further ado, let's get started. So in the first row, I'm going to lay down my years 0, 1, 2, 3, and 4. So the very first thing which, is a part of my calculation is first of all my sales revenue. So first of all, I'll need my sales volume, and then I'll multiply that with the selling price to find out my revenue. So it's 200,000, 800,000, 900,000, and 400,000 respectively. So these are my sales volumes. The next thing that I have is my selling price. Now, selling price is given per unit in current price terms before taking into account the selling price inflation of 4%. So what I have to do over here is take 15 and inflate that by 4%. So into 1.04 and raising it to the power of the year. So this is the selling price that I get for the first year. Similarly, I can copy paste the formula to the rest of the cells, but I will have to edit my selling price because this is changing every year. For the second year, it's 18. For the third year, this is 22. And for the fourth year also, it is 22. So these are my selling prices. Now, the product of these two is going to give me my revenue. So with this, I have my revenue. I can simply copy paste this formula to the remainder of the cells as well. Now, this figure that you get over here is your sales revenue. Now, the next thing which forms a part of our calculation is our variable cost. Now, variable cost is again over here given to us in per unit terms without applying the inflation. So, in 9 multiplied by the inflation for variable cost is 5%. So 1.05, and I raise that to the power of the year. Now over here, the price, the variable cost is remaining the same, so I do not have to change anything. So these are my variable costs which I have for the all of the 4 years that I have with me. Now, total variable cost is again going to be the product of the number of units that I make multiplied by the per unit cost. So this multiplied by my volume is going to be my variable cost. Now with this, I have my total variable cost. Now the next item which forms a part of your NPV calculation is your contribution, which is nothing but the difference between your revenue and your variable costs. So this over here was my revenue. I can subtract my variable cost to obtain my contribution. Similarly, I can drag the formula to the remainder cells as well. Now with this, I get my contribution with me. So these are my values that I have for all of the 4 years. Now the next thing that I have to do is subtract the fixed cost out of here. So the fixed cost is given to us in the question, and it is 500,000 in current price terms, and 8% inflation is applicable. So 500,000 multiplied by 1.08, because 8% is the rate of inflation, and raising it to the power of the year. Similarly, you can copy paste this to the remainder of the cells as well. Now, this gives you your fixed cost for all 4 years. Now, the difference is what you call your taxable cash flows, the difference between your contribution and your fixed cost. So, with this, you have your taxable cash flows. Right. So these are your taxable cash flows. Now, the next thing that we do over here is take our taxation into consideration. Now, the rate of taxation which is given to us is 20% per year, and we are paying the taxes in the same year also. So I can simply say equals to 20% of the above value, because these are my taxable cash flows. I'm going to pay 20% tax on these figures. Now, the next adjustment or the next calculation which I have over here is my TAD benefit, my tax allowable depreciation benefit. So I need to do my workings for the same so that I am able to arrive at my values. So this is my working for TAD. Now, let's find that out. How much would that be? So first of all, let me look at my initial investment. So my initial investment over here is $2.5 million. So $2.5 million. This is my initial investment. Now, on this, I have a tax allowable depreciation of 25% on a reducing balance basis. So, for the first year, I have my depreciation, and this depreciation is at 25%. So, 25%. Now, this is my depreciation, and now the benefit is going to be at the rate of 20%, because that's the rate at which I pay my taxes. Now, similarly, for the second year, my WDV is going to be the difference between these two values. 2.5 was my initial investment, 625 depreciation I've already charged. So in the second year, my depreciation is going to be 25% of the above figure. So if you copy paste the formula, it automatically picks up the value from here. And for the benefit also, I can copy paste the formula. Now this is the benefit that I'm going to get because of my tax allowable depreciation in the second year. This is 93,750. Now I can work out the WDV again for the next year. And in the third year, my depreciation, I can simply copy paste. So this is my depreciation and this over here will be my benefit. Now let's talk about the fourth year. Now in the fourth year, my WDV becomes the difference. So this over here is my WDV. And let's also have a look at the scrap value that is provided to us. So the scrap value which we have, the production equipment would have a scrap value at the end of 4 years of 125,000 in future value terms. So that means 125 is what is going to be my scrap value. So my scrap is 125,000. So the difference that I get over here is going to be my, the amount on which I get my balancing allowance. I can copy paste the formula over here, and this is going to be what, what's the benefit that I'm getting in the last year. So this is my benefit for year 4. Now I have done the calculations, so I can just label TAD benefit over here. And with this, I can link the figures. So for the first year, the benefit that I have worked out is this over here, 125,000. For the second year, I've gotten my benefit as 93750. For the third year, I've got it as this. And for the fourth year, this is how I have arrived at my depreciation TAD benefit. Now, what I will get after, netting off these three, I will get my cash flows after tax. So I can say that these are my cash flows after tax. So the simple formula which I can use is, these are my taxable cash flows. I subtract the amount of tax that I pay and I add the benefit that I get. So this over here are my cash flows after tax. Now I've made my adjustment for tax. The next thing, a few more things before I work out finally the NPV. The next thing that I take is my initial investment as well as my scrap value. So my initial investment over here is 2.5 million. I already have it written with me over here. So this is my initial investment, putting it as a negative figure because this is indeed an outflow that I have. And the scrap value, which is given in the question, I also have it written over here. So this is my scrap value, 125,000. Then the next thing that I have to take into consideration finally before working out my NPV is going to be my working capital. So it is mentioned in the question that we have a working capital requirement of $1.5 million at the start of the first year. Start of the first year basically means year 0. So right now I have to make this investment. So $1.5 million over here. This is $1.5 million that I've put over here. And the next thing that I have to take is, the inflation that applies to my working capital. So working capital inflation is 6% per year. So equals to this into 6%. So this is the inflation that will be applicable. That means after I have provided for the working capital of, 1.5 million in the very first year, in the next year, I'm going to have to add 90,000 more to it. Now, with this, my total of working capital becomes 159 and 4 zeros. So on this value, now I need 6% more. So equals this plus this, and I multiply that by 6%. So this is the incremental, this is the extra working capital that I need in the second year. Now for the third year, again, I will add all of these three. So equals to this plus this plus this. This all is my total working capital and I need 6% more. So multiplied by 6%. So in the third year, I'm going to have to spend this much again on my working capital. Now in the last year, all of this is going to come back to me. So I can simply say equals to sum of all of these, and I can put a negative sign over here because all of this is going to be an inflow, and at the end your sum of working capital should be 0 over here. So all of the working capital which you have put in the last year, that all comes back to you. So this is the adjustment that we have done for our working capital. Now let us work out our net cash flows. So our net cash flows will be netting off all of the things which we have just worked out over here. So cash flows after tax, initial investment, scrap value, and working capital. These are my net cash flows. I have copy pasted the formula to the remainder of the cells as well. Now, what's the next thing that I have to do? The next thing that I have to do is simply work out the NPV. The discount rate I already have as 12% over here. So equals NPV. I choose my discount rate at 12%. Then I select my values starting from year 1 to 4. And then I manually subtract my initial investment. So with this, I have my NPV. By default, this takes, the percentage format. So it's okay. You have to convert it to the currency format. ACCA practice platform also, you will be able to change your formats to currency. Now with this, you have worked out your NPV, which comes to roughly this number, which we have just worked out. So we are now done with the first part of the requirement. You would think so, but we are not. The first part of the requirement, if you read carefully, wants you to calculate the NPV of the investment project in nominal terms, and which means there's something more that we are supposed to do, comment on its financial acceptability. So a comment will always carry marks. So if you leave it till here, you only get 11 marks. For the 12th mark, you have to leave a comment. You will say that the project has a strong positive NPV and should be accepted. So this is the comment that we're supposed to write over here. Now the next part, part B, wants you to talk about how the CAPM model can be used by this company, Hebac company, in making a better investment decision with respect to its new product launch. So whenever a company is getting into something new, basically using of its discount rate as the the WAC, the weighted average cost of capital, is as long as the project's business risk as well as the financial risk is same, then the company can definitely use their existing WAC. But in a scenario where they're probably trying to venture into something new which they have not done previously, they should go ahead and calculate a risk adjusted WAC. And the CAPM model can help with that. The CAPM model will help to give them a project specific discount rate accommodating the financial risk that the company has, along with the changed business risk now that we are entering into something new. So basically, how you can explain this for an 8 marker requirement is, first you talk about, how the VAC will only be useful if the business risk and financial risk are remaining the same. But in case the business risk is changing, CAPM model should be used. And then you explain the steps briefly, that you first take a proxy company which deals in the business which you are venturing into. So let's suppose over here we are getting into a new product which is outside our business operations. So we should go to the market in which we are launching the new product, try to identify a good company, a good player in that market, look at its betas. You get the beta and then you de-gear it, then you get the business risk that this industry has, and then you re-gear it according to your financial status, your company's financial gearing. So this is how you get a CAPM model will help you get a risk adjusted discount rate, which you can use to appraise your investment project. So if they use the risk, if they use the discount rate which they arrive through with the CAPM model, then they will have a better investment decision. So this is how you will explain this 8 marker requirement. With this, we have come to an end to this question. I'll catch you in the next one. I hope that this was useful.